I'd like to pitch the idea of put options for pensions. As a citizen, you want to ensure that your pension funds are not zero when you stop working. However, it's normal that your pension fund invests your pension in stocks to increase the interests and maximize your savings, because otherwise you could just get the money in the bank to a 0% interest rate. However, stock markets are volatile, and if you retire during a recession, you thus risk that the assets are below the value that you would have had if you had just kept your money in the bank at this 0% interest rate. Insurance companies could just step in, this is my suggestion, and provide a put option for pensions so that your savings would never be lower than a certain preset value that you agreed with the insurance company about. This insurance company would be interested in providing this put option because they would then buy the assets from the owner of the pension, and they have a longer time frame, so the assets would probably increase in price again. It's just because the person who retired do not have the time to wait for the assets or the stocks to increase again. We know from previous recessions that even though it might take some time, assets and stock markets they come back to the previous values. I should note that it's already possible to hedge the risk of your pension to some extent, as most pension funds have the option that you can adjust the ratio between risky assets and safe assets. However, most safe assets will also potentially drop if the recession is very severe. So you could insure yourself to this risk. And the solution is thus very inspired by the approach that we saw in class, where you could buy the put options to minimize the losses on real estate. Now it's just with pension funds.